Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
The only free lunch in investing is diversification. And you've heard this before. You want to have some money in stocks and some money in bonds. Most of you are aware that you can lose money, a lot of money in stocks. But are you aware that you can lose just as much in bonds? That's what we're going to get into today. Welcome to the program, everyone. Joe Anderson here. I'm a certified financial planner. I'm with Mr. Alan Clopine from Pure Financial Advisors. What we want to dive into today is talking about the risks, a lot of risks that you're taking in your overall portfolio, because here's what potentially could happen to you. You're taking on risk in stocks, right? We all know stocks can go down, but you also have money in bonds. But if bonds go down and stocks go down, your whole portfolio is going to potentially blow up. That's what's on my mind today. So let's get into it. Let's get into the basics. First of all, what is a bond? No, not this bond. Let's talk a little bit more about investing in bonds, right? When you look at investing in bonds, it's like, all right, well, it's just an IOU. You're acting as the lender. You're giving a corporation, the government, a piece of your capital. They're utilizing that capital, and they're giving you an interest rate in return. It's just an IOU. It's a loan. However, if you're not prepared for the volatility in interest rates or defaults, that's where you can get hurt in your overall investment strategy when it comes to bonds. Let's break it down a little bit more. Let's bring on the big man, Big Al Clopine. Alan, we're talking all about bonds today and trying to get our viewers a little bit more perspective that, A, you should own bonds in your portfolio. There's a lot of talk in the overall media that, hey, there could be a bond bubble. Let's kind of break it down to figure out exactly what a bond is, how it works, and what risks are associated with bonds.
Well, Joe, I think it's important, especially in this market where we've had the stock market at all-time highs. And bonds, a lot of people are saying there's a bond bubble. So now what? Now what do you do? And so we want to spend some time today going over bonds, how they work, and most importantly, should you have bonds in your portfolio? So for today, we'll talk about advantages and disadvantages of holding bonds. We'll get into some of the risk factors, and a lot of you don't realize that you actually can lose money in bonds. So we'll discuss that, and we'll discuss, more importantly, ways to protect yourself. And then finally, the key question is, should you be holding bonds in your portfolio? I'll give you a quick snapshot. The answer is yes, but you want to be careful as to what type of bonds that you buy. And Joe, this is one of those things. It's like, what do you do right now? Markets are at highs, bonds seem to be at highs. Where do you put your money? It's confusing.
Yeah, and most definitely. If you look at your investment strategy as building a home, right? You want a strong foundation if you're building a house. Well, that's just like your portfolio. You want a strong foundation in the overall portfolio, and bonds will play a key component with that. But you want to be aware of different types of bonds because different bonds have different variations of risk. And so you want to be prepared to say, all right, well, if I want to get a high coupon or a high interest or high yield, just know that you're taking on a little bit more risk than if you would if you were not getting a lot of interest on a shorter term bond. So we'll break it all down for you because most people just search for returns out. If you look at what's more important in an investment, is it return or is it risk? A lot of times people say, well, show me the return. They don't understand the risks that they're taking in the overall investment.
Well, that's right, Joe. So why don't we start with advantages of the bonds? And so right off the bat, I would say stability. So you're less likely to lose money in bonds than stocks. You still can lose money, but you're just less likely to. And number two is the income. Interest is paid regularly, and it's often paid quarterly, sometimes twice a year. In some cases even once a year, but you know when it's coming. When you own a stock, it may pay a dividend, and it oftentimes pays quarterly, but you never know the amount. Many stocks don't pay any dividends at all. So at least with bonds, you know you have a certain amount of income.
Yeah, it's a contractual agreement with the overall company. You're loaning your money out to that organization or the government for a certain period of time. Here's my capital for 20, 30 years. I'm going to receive 5% interest rate, 2%, 3%, whatever the interest rates are. You receive that coupon payment or that income payment at the end of the term of the loan or the bond, you get all of your money back. So there's some stability there. But then you have to take a look at, all right, well, there's other advantages too. You might have some tax advantages in certain types of bonds. Or if you want to stay very, very safe, you might want to go with a treasury bond or a T-bill because that's the safest investment on the planet. But if you look at the 10-year Treasury, it's what, 2%. So you're giving your money to the federal government for 10 years for 2%. You're not outpacing inflation, so you're basically losing money on that transaction. So you have to compare all of your options to make sure how does this all fit in your overall portfolio. And it basically starts with your goals, dreams, aspirations, and so on.
Right, absolutely. Now there are disadvantages to bonds. And right off the bat, I would say that there's lower returns compared to stocks. I mean, bonds historically over the last 80, 90 years have returned about 5%. Stocks closer to 10%. And another problem with bonds is they're not inflation protected, at least most of them. There's one type that is that we'll get into, but most bonds are not inflation protected, meaning that during periods of high inflation, you're really losing purchasing power. In other words, a bond is just a loan, it's an IOU, and with interest rates, they stay generally fixed, and when they're fixed, then you get that interest payment regardless to what inflation is. So maybe you're getting a 5% interest rate, and now interest rate's 10%, and maybe inflation goes way up. That payment that you're receiving will feel like a lot less.
Yeah, I mean, then you can get into, all right, well, looking at the long-term averages, stocks will pay you more than bonds because you are receiving, right, more compensation for taking on that type of risk if you hold that stock for the long term. If I buy a bond, well, then I have some stability here. I have a little, some safety. So if you look at the compound returns, just as Al said, stocks over the last, what, from 1926 to 2012, have averaged close to 10%, while bonds are around 5%. But then if you take a look at inflation and taxes, well, your stock returns are now down to 4.5%, and your bonds are almost negative. So then it's the mix. It's like, all right, well, what do you do? How much money should you have in stocks versus bonds? And that's what we're going to get into a little bit later. When we get back from the break, we have our good friend, the CEO of Pure Financial Advisors, going to be joining us. And Al is going to talk to Mr. Mike Fenison, and we're going to ask him some questions. All right, first of all, should you own bonds? What type of bonds should you own? What are some risks associated with that? So you do not want to miss this next segment. Yeah, handsome devil, isn't he? Look at him. All right, don't go anywhere. We got a lot more to discuss. Show's called Your Money, Your Wealth. We'll be back in just a second. Hey, welcome back to the show. Joe Anderson, Alan Clopine, hanging out today. Show's called Your Money or Wealth. And speaking of wealth, we're talking about bonds in your portfolio. Stick around this segment. We got Mike Fenison, CEO and founder of Pure Financial, head of the investment committee. The firm manages over $1 billion, so we're going to dig in and figure out exactly what you should do with your bonds. But before we do that, let's go to the true-false question.
Investors
who need income must own bond alternatives. So bond alternatives, here's the thing. Now, right now, because interest rates are very, very low, people are looking for alternatives to find that income. So maybe it could be a master limited partnership. Maybe it's a dividend paying stock. Maybe it's a high dividend yielding mutual fund or exchange traded fund. Multiple different strategies that are very, very popular because a lot of individuals are retiring and looking for those high yields. Be careful. We don't agree with that strategy at all because there's a lot of risk with those investments. We look at a total return approach when it comes to creating the income that you need. That's a totally different topic and a totally different show. Al, what's your comments?
Yeah, I agree with you, Joe. I mean, so that's what people want to do right now is there are such low yields in bonds, and the stock market seems to be at all-time highs, and it's so you want to look to other things, but people don't realize that some of these other things, master limited partnerships and some of these other investments come with a lot of risk, and in some cases you can lose all your principal if the investment goes bad. So watch out for these kind of strategies. But with that in mind, I want to introduce our special guest for today, and that's Mike Fenison. He's a certified financial planner, CEO, and founder of Pure Financial Advisors. Mike, welcome aboard today.
Glad to be here, Al.
So I want to ask you the key question on everybody's mind right now. Given the market conditions, given the stock market is at or near all-time highs, everyone's saying there's a bond bubble. So should people still invest in bonds?
Well, for most people, the answer is yes. It's understanding what the role of bonds is in a total return portfolio. And the main advantage of bonds is that it gives you a relatively predictable way of controlling the risk in the portfolio.
Okay, so we need it because if we don't have any bonds, like let's say we go 100% stocks, for example, then we're at the mercy of the market. Market goes up 20%, that's great, but market could go down 50% as it did, say, in 2008.
Right, and we can't really predict the direction or magnitude of stock market changes, but if you add a bond component to that, you can mitigate that volatility. And you can control it so that it matches with the cash flow requirements of a client or matches up with their financial planning so that they know that they can weather a storm either in interest rates or in stock market movement.
Well, that's a good point because liquidity, I mean, that's when you're in retirement, for example, and you need assets to live off of. If you have all your assets in the stock market and the stock market has taken a dive, and you're pulling money from the accounts at the same time, it's hard to recover. If you've got some bonds that are more stable, you can pull assets out of your bonds at those times.
Right, and you have to look at the overall portfolio. So for example, if you needed cash in 10 years and you had a 10-year bond, even if interest rates were to spike and the current value of that bond were to drop, that value would be restored by the maturity date of the bond. So you really wouldn't get any less of an expected return than when you originally purchased the bond.
All right, so given this economic climate with interest rates pretty low, and at some point, we don't know when, but at some point they'll likely go up, what kind of bonds should people be looking at?
Well, it depends on their tax bracket. So if they're in a very high income tax bracket, they might be looking at municipal bonds. But in general, you want to be looking at shorter term, higher quality bonds. You'll avoid some of the credit risk with high quality bonds, and the shorter the duration or maturity of the bond, the less interest rate sensitive it's going to be.
Yeah, because bond prices actually go up and go down based upon interest rate changes. And there's an inverse relationship, right? As interest rates go up, bond prices actually go down. And
there will be a sea change. For the last 30 years, interest rates have been in a relative downtrend, which means when you look at the total return of a bond that's liquidated before maturity, you're not only getting the coupon rate, but you're also getting a capital gain because you may be selling it at a premium. When interest rates start going back up, then if you sell a bond midstream, you're going to get the coupon rate probably taking a discount if you want to liquidate it. So it's really important to tie those maturity dates and duration of the bond to what your cash flow requirements are so that you're not forced to liquidate those bonds before you need the money.
Now, and I agree with you, short-term bonds, high quality are probably the way to go, but there's not much yield in them. So should that concern us?
Well, certainly everybody wants higher yield. Everybody wants more and they don't want to take any risk. But risk and return are related, and it doesn't matter what type of an investment that you're looking at, there's a direct correlation between risk and return. So if the bond rates are not high enough for the appropriate bonds to your portfolio and you start searching for higher yield somewhere else, there's going to be a corresponding risk associated with that investment that may not show up. You may not be aware of it until it's too late.
Yeah, and I would say what's interesting about bonds is when you take more risk, when you go longer term, or when you have lesser credit quality, yeah, you get a little bit higher yield, but that yield is not that great, not that much greater compared to much safer bonds. And you do get compensated more in the stock market. So if you're going to take risk, you might as well take it in the stock market side.
If you want more risk, you take it in stocks, not in bonds. And when you're looking at how long you want to go out on the bond, you're looking at at what rate of return you're going to get, and is it tied to your financial planning? But the yield curve is what you're looking at, and the yield curve doesn't necessarily change the same for all bonds when there's an interest rate spike. So there might be something to happen in the interest rates, and short-term bonds may be affected and longer-term bonds may not, or the opposite may happen. So not all bonds are going to react the same to the same stimulus in the economy.
So now we're getting complicated, yield curve and so forth. But the key is, yes, most investors probably still want bonds, probably want to stay short-term and high quality in this bonds in this environment. So where can people go for more information, Mike?
Well, for more information, I mean, bonds are a complex topic. And if somebody's concerned that interest rates may adversely affect their portfolio, we offer a free portfolio review and assessment at Pure, and we'll take a look at their entire portfolio and the role that bonds are playing within that portfolio so that they can understand the risks and the potential.
Right. Well, thanks, Mike, for joining us.
Here,
So,
let me do this. Let me try to break it down maybe a little bit more simple, right? I'm a simple guy. So if you look at, all right, companies issue bonds, and a bond is just a loan, right? So you go to a company and give them $100,000, they pay you an interest rate. Let's say it's 5%, $5,000, that's your income. Let's say you have that bond for 30 years. They're taking your capital, utilizing your money for 30 years in exchange for a 5% coupon or interest or income payment. At the end of the 30 years, you get your money back. But where people fall into problems is if they try to sell that bond prior to the maturity date. And if interest rates go up, this is the problem, is that the company's not going to take that money back because they don't have it anymore. They hired a new CEO or infrastructure, or they had new inventory. They needed that capital to grow the bottom line. You need your money. So what do you need to do? You go to the secondary market and try to find someone else to purchase the bond. Real simple example. Let's say bond prices go to 7%, okay? You have a $100,000 bond paying you 5%. Someone else says, all right, well, I can buy your bond and get $5,000 of income, or I could go somewhere else and get $7,000 of income. No one is going to buy that bond. Why? You have to entice them. I would rather have $7,000 of income versus 5. It makes sense, correct? So here's what they have to do. They have to entice you instead of saying, all right, well, maybe not 100,000, but maybe 80,000. Does that pencil out? So here you get your liquidity, but at a deep discount because interest rates go up. That individual then gives you $80,000. Okay, you have your liquidity. They have your bond now. They get the $5,000 of income for the rest of the term, and at the end of the term of the loan or the bond, they get the full 100 grand back. So the company issues it at par. Now, if interest rates go up, so from 6.25 to 7.5, well, the value of that bond is going to decrease. They have to entice you, right? You have to entice that individual to purchase it. Now, if interest rates go down, bond prices go up. Think about this. I think most of you could remember, you could go to a CD and get 5%. Money markets were paying 5%, right? So bonds were paying a lot higher 10, 15, 20 years ago. Interest rates have gone down. Bond prices have gone up extremely high. So we're in a bull market, if you will, in bonds. Just be careful. Identify what type of bonds that you own, knowing that if interest rates go up, that bond price will fall. The longer the term, the more risk that you're taking. The shorter the term, the less risk. But less risk means lower return. So there's a yin and yang here, if you will. That's why planning is so important. Talk to your financial advisor, talk to your tax professional to figure out exactly what is the right bond for your overall portfolio and build that to make sure you don't lose your money. All right, we got to take another break. When we get back, we're going to dive into your email questions and break down the show real quickly. Don't go anywhere. Got a lot more to go. Show's called Your Money or Wealth.
This week's question is, why invest in international markets? We often see investors with a significant bias towards U.S. stock, the thinking being the U.S. is either the safest or best returning market, and investors should just buy what they know. On the contrary, here are a few reasons to consider why international diversification makes sense. Number one, diversification is an investor's best friend. One of the most effective ways to reduce overall portfolio risk is by being broadly diversified across sectors, asset classes, and global markets. Number two, there can be correlation benefits from international diversification. Country returns can behave differently at different times. This correlation benefit works to reduce overall portfolio volatility, which can increase compound returns. The final reason being, international markets often have similar and sometimes better returns than the US. By excluding international markets, investors can leave returns on the table.
Hey, welcome back to the program. Show's called Your Money or Wealth. My name's Joe Anderson, certified financial planner. Talking bonds today, fixed income, making sure that you are aware of all the risks with your bonds. We're going to switch the show over to you and get your email questions here in just a second. But before we do that, let's go to the true-false question.
Individual bonds are better than bond funds. And Joe, this is one of those questions that could be true or false. It depends. It depends upon you. So I think if you have a lot of money to invest, individual bonds are probably a little bit better way to go because you know what the maturity is, you know what the interest rate is, you have control over it, right? But for a lot of people, they don't have enough money to diversify. Maybe they got $10,000 and you don't necessarily want to just buy one bond. if something happens with that bond, you could lose a bunch of money. So for that kind of person, a bond fund might be better.
Yeah, I would say in most cases, Al, a bond fund might be better suited if they understand the mechanics or the makeup of that bond fund. Because you can get hundreds or thousands of different bonds inside a portfolio at a very low cost. With the transparency on Wall Street, if you try to buy individual bonds at even levels of $100,000, the pricing on that is pretty high. So if you want a little bit more diversification, we would suggest, you know, hey, have 100 bonds maybe versus one. So yeah, there's pros and cons to each. But if you understand the makeup of the bond fund and saying, all right, well, here, I have a long-term bond fund or a short-term bond fund, you understand or identify the risks associated with that. So yeah, that's a toss-up, Al. It really depends on the individual investor. There's pros and cons to each.
Well, it is. And Joe, so let's summarize our show on bonds. So we want to go over some of the key points. And I would say number one is that bonds are IOUs from governments and companies. So it's just a loan. You're loaning the government or a company some money, you're getting a payment back. Stocks do not always outperform bonds. There's some years where stocks go down, bonds don't go down as much, or bonds maybe even go up.
Right. I mean, I think that's what the key component here is, right? It's diversification. You want to have negatively correlated asset classes. And so if you look at 2008, of course, the top performing asset class wasn't stocks, they were bonds. So they're there to protect your overall portfolio. So yeah, that's why you want a little bit of each, you know, in your overall portfolio.
Yeah, Joe, and of course, as we mentioned, you can lose money in bonds, and interest rates and bonds have an inverse relationship. So bond prices move in the opposite direction of interest rates. And so we'll tell you, don't invest all your money in bonds. And right now, and probably actually generally this is best, consider short-term, high-quality bonds because they're not as impacted from interest rate changes, inflation, because they turn over quickly. Yes, you give up a little bit of return, but you make a lot higher return if you take a little bit more risk in the stock market, such as small companies and value companies do better than larger companies and growth companies. You just take a little bit more risk in that stock market. Don't take so much risk in the bond market because you're not really compensated that much more for that risk.
Yeah, but I mean, if people invested in long-term bonds over the last couple of years, you know, they've enjoyed that nice high return because for years and years, right? How many times have we heard this, Al, that interest rates are going to go up? They're going to go up. They have to go up. They haven't gone up. They can stay low for quite some time. So understanding your overall goals and objectives in your portfolio to determine what rate of return is probably the best solution there for the best portfolio for you. Let's go to the email questions. What do we got today?
All right, we've got Mike from San Marcos, and he says, can I avoid the pro rata rule with my IRA conversion by opening separate accounts? Well, that's a loaded question. First, let's talk about what the pro rata rule is, which is when you do a Roth conversion, when you take money out of your IRA and convert it to a Roth, you pay taxes on the conversion. Once it's in the Roth IRA, all future income growth in principal is tax-free. What you're talking about is if you have tax basis inside your IRA. Let's say you did a non-deductible IRA for $5,500 this year and in a new account and you want to convert it, you pay no tax because you didn't get a tax deduction. Well, no, the IRS says that you have to aggregate all accounts together and you take that $6,000 basis, you divide it into all of your accounts. Let's say you got 200,000 bucks of IRAs. 6,000 into 200,000 is only 3%, so only 3% of your Roth conversion is tax-free. So when you have separate accounts, it doesn't matter. You have to aggregate them all together.
Yeah, that's a big mistake because there's something that's called the backdoor Roth IRA contribution. So I can put basis in because I'm already taxed on that, and then if I convert it, I don't pay tax. But it's the pro rata and aggregation rules. Yeah, we're getting a little complex here on these emails. Let's go to the next one, see what we got.
Yeah, that was kind of sophisticated. Here's Bill, Kearney Mesa. I plan to delay my retirement until I'm age 70, which will put me at the highest tax bracket until I stop working. I think he means to delay his pension payments until he stops working. Should I take my pension as a lump sum when I retire, or should I take it over time? Wow, that's a loaded question, Joe. I'm going to turn that one over to you.
Well, I mean, it depends. I mean, so there's pros and cons to each of them, right? So if I take the pension or the annuity, then I'm going to receive that income for the rest of my life. If I take the lump sum, well, then I have a little bit more control over the assets. I can invest them the way I choose. I can take the distributions when I'd like. I have a 70.5 though rule still in those pensions where I have to take the money out, regardless if it came from a pension or if it came from a 401k plan. In most cases, the pension probably makes the most sense because that's going to be a guaranteed income for the rest of your life. And so if you take a look at longevity risk is one of the biggest risks that a lot of retirees are facing right now. So you want to make sure that you have that paycheck. But you also take a look at what is your Social Security benefits? How much money do you have in IRAs and 401ks? What is your longevity? What is your Social Security benefit? The list goes on and on and on. That's why doing a little bit of planning before you make that decision is so important because it's irrevocable. And everything is taxed at 100% ordinary income. What we're going to get into next week is talking about tax-free income. Most people want a tax-free income, but do you have a strategy to get you the income that you need tax-free? That's what we're going to get into next week. That's it for us. I want to thank Michael Fenison, CEO, founder of Pure Financial Advisors, Big Al Clopine. I'm Joe Anderson. You just saw another episode of Your Money, Your Wealth. Have a great weekend, everyone.